Hello traders, good day to you everybody. I've come again to give you additional modification to my four basic entry rules. You know, I did a video on four rules for entry. Okay, I'm going to revisit that rule today and then show you additional, rule to support, that entry rules. Okay, because I hate losing in this market, so I always look for tricks, ways, formula to get better and better and better. This week I'm focusing on entry techniques, and for the past 2 weeks now I've been working on my entry, because if our direction is right, if I have a forecast, a success rate of 90 to 95%, there's no reason where whatever group I belong, there's no reason why they don't make money there. It's not just possible. If my direction is always right, then we should always make money. So the only thing that can be an obstacle for us or to us making money is if we have a bad entry. Of course, you can forecast your direction right, but if your entry is not right, guys, you may not make money. So since we are expert in forecasting, we must also be an expert in entry. So I've been working on these entry techniques, and I've got 4 basic entry rules, and then I link it with multi-time frame analysis. I link it with session analysis. I link it with candlestick pattern. All right. And I put everything together to develop an entry system that is rule-based. And we have 4 basic rules, to ensure a good entries. I'm going to revisit that 4 basic rules, and I will now add, a modification to the entry rules. Essentially, those entry rules are tested with data, and they are found to be very, very good, whenever we see them in the market. But then there is one signal that may make you to have to wait to get additional confirmation, which I'm going to show you. I'm not going to overcomplicate things, guys. So we're going to use the case study of 2 yen pairs. All right, we're going to make use of UJ and EJ. We're going to make use of UJ and EJ. That is USD JPY and Euro JPY. We're going to use 2 examples to illustrate this point. Of course, let's just start from daily. In the case of let's go to EJ first. Euro JPY. Okay, you know that right now we are at the top. We don't want to buy at this stage, but even though the market will still like to move to the upside, because you see on the monthly time frame is still bullish. Okay, it's most likely that this might be a contracting flat for this impulse, and then this move to the upside. So it's most likely that we'll get to this level on Euro JPY. Okay, because right now on the fundamental point of view, you know that even though Eurozone economy is struggling at the moment, we have a lot of inflation. You have a problem with the biggest economy in Europe, which is Germany. You have a lot of problem right now, inflation, energy crisis, and so on and so forth. So right now, the balance of payments in Eurozone is nothing to write home about right now. The current account is nothing to write home about. So there are a lot of problems with Eurozone economy. But then the Japanese economy is not also spared of all this trouble. And if you look at it, recently, European Central Bank has raised their interest rate. from the one that they have kept. They've kept it on zero for a couple of years, for almost a decade. You understand? But now they have moved it from 0% to 0.25%. So euro is becoming a little bit more attractive. But of course, you know that JPY has made their interest rates to remain at minus 0.1%. Minus 0.5%, the difference between that and 0.25 is about 1.25, 125 basis points. Can you see? So we have a lot of differential in interest rate between euro and JPY. But don't forget too that JPY, they have a lot of trade surplus in their favor. They have a lot of trade surplus in their favor. So if you are thinking of upside in euro JPY, be careful, because you cannot think that you can be buying euro against the yen persistently now. You can't be thinking so, because despite the negative, you know, interest rate on yen, it is still attractive to the investors, because yen is the third most traded currency in the market after the USD and the euro. Yen is the third most traded currency, and yen is Japanese economy is also very attractive because they have policy of homegrown economic development, okay, and they have a lot of surpluses in their export. They have excess surplus, they have excess export over import. They import less and they export more. Do you understand? So now let's go straight now. We have understood the background fundamentals. Let's go to technical now. So you see on the monthly, it's still bullish. No doubt about that. It's still very, very bullish. So on the weekly, you see that though it's bullish, but you can see that the move to the upside is not as strong as it was when it started here. Okay. And if you go to daily, you see that we already see a selling pressure. This is a selling pressure at the top of the resistance here. This is a selling pressure. Okay. So what's going to happen right now is that we have seen that this candlestick pattern that matter, you have seen it here. You see this, when you see this at the top in a daily time frame, you see this candle, you see this is selling pressure. Okay, and I told you when we're doing time frame analysis, candlestick that matters. See, when you see this pressure, all you just need to do in order to get entry is to go back to 1 hour time frame. Okay, go back to 1 hour time frame. You must see a recognizable impulse. Okay, you must see an impulse that you can recognize. Okay, and where's the impulse, guys? Look at it from this level, from this level here to this level. This is the impulse you recognize based on the pressure that you notice in the higher time frame. Do you get now? So now the question you're going to ask yourself now is that part of the rule say you must spot impulse, and after impulse you must have a defined correction. Are we not having a defined correction here? It's ongoing. 1, 2, 3. We may have 1, 2, 3, and then 1, 2, 3. When this one finishes for me, that is a defined correction, guys. So what we have to do right now, real quick, is to take a fib of that impulse. It ends here. Okay, to take this fib, we now target 50 to 61.8 of that impulse, which is here. And if, remember, if this correction is a WXY or a WXY in form of zigzag or whatever the corrective structure, if it's in form of zigzag, then we have to target 78% retracement here. Okay, and after that you have to short to the downside. But before you short to the downside, part of the rule says that you must look left and see whether you see a demand level, demand zone. You can spot demand zone here. You look at the impulse, where is the biggest candle that is around our structural level. Our structural level in this case either 50 to 61.8 or 78% retracement. These are our two structural levels here. This is not our structural level because we are not expected to do anything before this level. I put a blue triangle, rectangle. Okay, so if you look left, that's rule 3. Rule 1 is impulse, rule 2 is correction, rule 3 is look left. Rule 3 is correction getting to the right fib level. That's your structural level. And rule 4 is look left. Do you see a supply? Yes. Where is the supply? See this big candle to the downside. Where's the candle that formed before it? Where does it end? This way. Where's the candle that formed after it? Where does it end? This way. So let's now delete the fib so that this chart will not be cluttered. Okay, which means based on our supply rule, this is the area that we are expected to short Euro JPY. Okay, this is the area we are expected to short it. Okay, so but now you have to look. I've given a rundown of the 4 entry rules. Okay, but now additional modification I want to bring into it is that you get to look at the impulse that is producing that correction. Here, look at the impulse that is producing that correction. And then look at the corresponding level and check the impulse, the bullish impulse that was there. Look at this bullish impulse and look at this bearish impulse. Which one is stronger? You get to check which one is stronger. You see that this bearish impulse at the corresponding level here, this bearish impulse is stronger than this bullish impulse. Am I correct? The push to the downside here, the push to the downside here is stronger than the push to the upside. Can we give a test? Yes. Look at the number of candles that are proceeding to the upside here. Can we count? 1, 2, 3, 4, 5, 6. You have 6 hours candle, 6 hours consistently. Market produce 6 candles in 6 hours. How many candles was produced at the corresponding level here? Only 1 candle, no, 2 candles. 2 candles push to the downside, 6 candles push to the upside. So in this scenario now, the seller at the corresponding price level, the seller, are more than the buyer. The volume to the downside is more. So that confirms to us that this pair has no room to the upside. It has only room to the downside. That is why when we get to 50 to 61.8, which is our first structural level, or if this is a zigzag, 78% retracement, which is our next structural level, we are going to take this trade to the downside with a measure of authority and accuracy. Do you understand? So additional, confirmation I'm adding to the rule is checking the balances of the impulsive leg. In a sell, you check the upside and the downside. Which one is better? If it is the downside that is better, then our structural level will give us a reaction to the downside. Now, let's check the second example of USD JPY. We want to see which one, what do we do in case the impulse, the immediate impulse we are looking for is not better than the previous one. What do? You go to the daily, you see we did the same thing. Did the same thing on the other one. See the daily, see we have a reaction. Okay, we have a reaction to the case that we could sell to the downside. Okay, now if you go to 1 hour, you see what I'm telling you. When you see a reaction, you must see an impulse in 1 hour. So now you see the impulse now appear correctively. Look at it. Look at the impulse we are meant to fib. All right. So the rule says you must see an impulse. And don't forget, impulse is not until you see something like this before you call it impulse. This is an impulse. And an impulse can also appear as this. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. This is also an impulse. So don't be confused When you see a strong pulse like this, you say, where is 1, 2, 3, 4, 5 here? So this is not an impulse. No. If it's strong pulse like this, it is an impulse. Do you understand now? Okay, so the rule say we must put an impulse, which is 1, 2, 3, 4, 5. Can we count this one? Yes, 1, 2, 3, 4, 5. So this is an impulse. We are looking for 1, 2, 3 so that we can sell. Okay, so the rule say look for impulse. In 1 hour time frame, we have gotten our impulse. The number 2 rule says you must be able to define the correction. You will notice that I always make definition of correction, you know, the second rule. First rule is impulse. Second rule is definition of correction. Third rule is what? Fib level. Okay, and the fourth rule is what? Supply or demand level. So why is it that I make, you know, a definition of correction as second rule and not fib level? Because it is the nature of the corrective structure that you want to define in rule 2 that determines the fib level you are going to expect. So if this is a flat corrective structure now, I'm expecting 50% retracement for the fib. I'm not expecting 78. But instead of this to be a flat, if it's a zigzag corrective structure, I'm not expecting even 61.8. I'm not expecting 50%. I'm expecting 78. So you can see that rule 2 states that there must be a clear definition. There must be a clear description of the nature of corrective structure that you are getting. And that alone gives you an instinct, give you, a guide as to the expected fib retracement level. Can you see it now? That's why fib retracement level is rule number 3. And then rule number 4 is check left to see that there is a demand level, assuming that this this ends as a zigzag corrective structure. So when you feel this impulse, you have 78% retracement at this level. So we are expected to sell to the downside here. Okay, so it means that 3 rules fulfill: impulse, check; definition of correction, checked; fib level of 78, check. Then 4th rule is look left. Do you see an impulse? Do you see a supply zone? So when we look left, guys, this is what we see. I told you that even if you see a supply level at this area, you need to compare the impulse to the upside in the corresponding level and the impulse to the downside. Guys, are you getting it? Where is the impulse to the upside? Look at it here. Where is the impulse to the downside that has just been corrected? Look at it here. Compare the two, guys. You will see, you will agree with me that the impulse to the downside here is not as encouraging as the impulse to the upside. Can you see? Can we count the candle? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Impulse to the upside, 10. Let's count this one, guys. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32. Can you see, guys? Only 10 or 12 candles to the upside here, but you have 32 hours to the downside. And if we have to sell, we have to have a good sell. This impulse to the downside should give us a fewer candles than this move to the upside. So does it then mean that we are wrong? No, it does not mean that we are wrong, but we have to modify what will give us an entry. Since our immediate impulse is not as encouraging as the previous impulse, what we have to do is, assuming this market develop a zigzag, which is most likely, in that case, if you give us 1, 2, 3, this is a corrective structure. And since this 1, 2, 3 move has not gotten to our structural level, expect another 1, 2, 3, and then another 1, 2, 3 push to the upside. So this becomes W, X, and Y. This Y has gotten to what? Where? 78. So now what you have to do is very clear. What you have to do is very clear right now. So impulse, checked. Nature of corrective structure, checked. 2. The third entry rule, fib level to 78, checked. The fourth rule, supply level checked. Now you don't even have a distinct supply level right here on the left-hand side. No clean supply level here. At the structural level, you don't have a clean supply level. So that's number one. Number two, if you look again, the move to the upside is more encouraging. It's more bullish than the move to the downside. So if that's the case, what are you supposed to do? Are you supposed to throw this trade away? No. This is now the modification to the rule that I want to bring to you, to the 4 entry rule. This is the modification. You now have to wait to see. You see that this area here, all this move here, they are corrective. You now have to wait to see an impulse here. What do I say, guys? You need have to wait to see an impulsive move here. Do not enter at this 78. This is a situation where you don't enter at this 78. Why? You do not see a supply level that can encourage you to have a push to the downside. So wait for another push to surface. When this push surface, this is now the push that you are going to do what? You are going to fib to determine your entry. This is the fib. You are now going to have to repeat the same entry rules right here, that you have an impulse, correct? Then you have the nature of correction. If it is just a 3-wave corrective structure like this, it can end at, this one does not really go deeper because you don't need a deeper corrective structure here. It can end at 0.5 to what? To 0.618 here, right here, real quick, guys. And then this is the level you are going to make your entry to the downside. Can you see? So, can you see? You are going to make your entry at this point. Boom. Stop loss above 78. Make a move to the downside. You see? Let's clear up some of these guys. Let's clean up some of these things. Let's clean up. Let's remove the fib. You see, if you had entered here, right here, if you had entered here, where will be your stop loss for this trade, guys? Where will have been your stop loss? Your stop loss will have been above the level here because you are entering at 78, above the level. But now, look at it, guys. You are entering here. Your stop loss cannot even be on top here. It can just be above 78. That's the rule. Take the fib, entry here, stop loss just above 78. Boom. Can you see, guys? So you now notice that by doing it this way, oh, sorry, guys. Oh, not this one. Sorry. This one, guys. Boom. Okay. By doing it this way, you are going to have a better entry, a confident entry, with better risk to reward. That's what you are going to get, guys. Okay. Yes. So you see that if you now look left at considering the 4th rule, if you look left now, you now see that this impulse here will be stronger than this one and this one. So in that case, once you have a strong push, a weak push, you wait. You see a weak push to the upside, and then a strong push to the downside. It means that the real selling pressure we are expecting now started here and not here. So why did it have to come to give a big and deep pullback to this level? It has to come and, take liquidity, okay? Prepare and gather momentum to pick order to the downside. And that's the result you see here. And after this impulse here, you take correction and then you take a move to the downside. This is the modification I'm bringing to what? To my 4 entry rules. So I'm making this video to add this particular, rule to that 4 entry rule. So that makes 5 entry rules right now that you must see before you confidently get into a trade. Do you understand now? And I'm very convinced that there is no way we will meticulously follow these 5 rules that we will not have a perfect entry in the market. If we are able to forecast our direction correctly, there is no reason why we should not get a perfect entry. And if we get a perfect entry, guys, following this method, following this system I've made available to you, there is no way you will not make money. All right, so I'm done with the video, and I'm sure you have gotten it correctly. If there's any area that is confusing in this video, don't hesitate to chat me on the chat box, on the chat section, on the comment section, right? So let me hear your opinion. So if there's anything you want me to throw more light on, just let me know. And then if you have not subscribed this channel, this is Nathaniel Tunde, that's my name. Please subscribe the channel, press the notification icon, so that you can receive every message, every video I drop, all my content. You are going to be the first to see it. All right, I'm going to be giving you, cracking videos, guys, videos that makes a lot of sense. The essence of, opening this channel is not really to make money from YouTube or to make money from, no. I've had more than 500 videos, training videos I've done in the past, but those videos now, I don't even know where they are. So I'm using YouTube to put these videos together, to have, a record, to be able to access a record. If I want to say, oh, which video I did so time, I can go to YouTube and bring it out and see it. That's the essence. But if you don't comment, if you don't subscribe, how will YouTube spread these videos to others? So many people just come, they enjoy the content, they don't comment, they don't subscribe. It's not fair. You want to be fair to me? If you enjoy my content, please just subscribe to the channel. Press notification icon. Come to the comment section and say, I like your work, or I don't like your work. You have to improve on this work, so that I know that I have to tighten my belt and put on my thinking cap. Like my daughter will say, put on your thinking cap. Okay, so that I will put on my thinking cap, think very, very reasonably, and produce a better content, for your enjoyment. All right, so that's it, guys. See you next time, guys. Bye for now. Peace.